What's up, you guys? Welcome back to my channel. Today I'll be discussing the fundamental topic that can significantly impact your trading success: chart patterns. Whether you are a beginner or an experienced trader, understanding these patterns is essential. So let's dive right in and explore the chart patterns every trader should know. So to start off, what is a chart pattern? What makes a chart pattern so unique? Chart patterns are visual representations of price movements on a trading chart. They help traders identify potential trend reversals, continuations, and market indecision. So if we start talking about what is the chart pattern, it's pretty much a set price action that is repeated again and again. The idea behind the chart pattern analysis is that by knowing what will happen after a pattern in the past, you can take an educated guess as to what might happen in as when it appears again. So the outcome of each chart pattern will vary depending on whether it appears in volatile or calm markets and in bullish or bearish environments. So if we start talking about the common types of chart patterns, let's discuss two broad categories of chart patterns: the reversal and continuation patterns. So the first type, reversal patterns, indicate a potential change in the direction of the current trend. So as you can see, they pretty much indicate a trend that's going to change the direction. And examples include the head and shoulders pattern and a double top bottom. These patterns can signal the end of an existing trend and the start of a new one. And if you come to the continuation trend, continuation pattern suggests that the existing trend is likely to continue. So as you can see, these signals are a current trend line that will continue. And examples include triangles and flags. Recognizing these patterns can help traders stay on the right side of a trend and capitalize on potential price movements. So to start off, there is a few different types of chart patterns that we could discuss, which I'm going to be discussing in this video. The ascending descending staircase, as you can see in the diagram or this little example right here, the ascending staircase is pretty much increasing, while the descending is the opposite, decreasing. As you can see, it increases, goes down like a staircase. So it looks just like a staircase on the upper positive momentum, and then a decrease in negative momentum, where it's going to go to create a new trend line. So ascending and descending staircases are probably the most basic chart patterns, but they're still very important to know if you're interested in identifying and trading trends. So in a ascending staircase, a market is moving upwards, as I was mentioning, while it retraces occasionally, and it was still hitting higher highs, and the lows are getting higher too. This is what a bull market generally looks like, and traders will consider going long until the uptrend comes to an end. So as you can see by the dips in a trend can even provide useful buying opportunities, enabling you to get into the rally at a discount. But when you come to pretty much the descending staircase, the downtrend, a trader could use the mini rallies to get that go against the bear run as opportunities to sell. So when we start talking about ascending triangles, this is a very good topic with ascending triangles. As you can see, ascending triangle is a chart pattern that is pretty much created when a horizontal set of highs is met by ascending set of lows. As you can see right here, we're in a triangle. We're seeing it staying within the triangle, within the resistance and pretty much the baseline. And as you can see, it breaks above the baseline and the resistance line, and pretty much it goes in an upward trend. As you can see, it's a continuation pattern, usually appears after an uptrend. Over the course of the pattern, the market consolidates, which means the trend stalls. But if it breaks above the resistance line, which I was mentioning, the resistance line right here, then pretty much it starts a new uptrend should form. So as I will cover down as below, traders will usually look at the confirming pattern before they start trading. One way to confirm the ascending triangle is to look at the volume indicators. Very, very important. The volume indicators is very important to see how much people are buying in. What is the buying pressure? Is this buying pressure going to break the resistance line? This is pretty much the activity that should decline with the pattern. But then quickly pick up as a breakout takes hold. If this arises, then the price is more likely to continue upwards. Although this price doesn't typically break out in the same direction as the prevailing trend, it doesn't always happen. Ascending triangles can indicate a start of a new downtrend if price breaks lower or the volume, as we say, volume indicators is very important, declines. And as you can see with the descending triangle, this is very similar to the ascending triangle, just the opposite version of it. With the descending triangle is pretty much the opposite of the ascending one. That usually occurs after a downtrend and is formed when a horizontal set of lows, the support line, which is right here, is met with a descending set of highs, resistance. So as you can see, it broke down. There was a big selling pressure right here. It was in a continuation phase. It started accumulating again with probably with the volume and probably new buyer interest. As you can see, it stayed within the descending triangle formation. And as you can see, the selling pressure overtook. So you can see now it's trying to have some type of support to see if this trade of the direction of the breakout still continues in descending form. So as with the ascending counterpart, falling volume within the pattern, falling by a spike as the market breaks out can make for a stronger signal. So if we talk about different types of flags, which is very, very important too. So the flags, there's pretty much a bullish flag and a bearish flag. And the flag patterns are created when a market support and resistance line run parallel to each other. As you can see right here, they run very parallel within each other. And either sloping upwards or downwards, it accumulates in a breakout in the opposite direction into the trend lines. So in a bullish flag, both lines point down in a breakout through the resistance signal. As you can see, the trade of the breakout, you can see it's going down. It's more of a bullish flag pendant, and you can see it broke above and it started making newer higher highs. And in a bearish flag, both lines point upwards in the breakout through supporting signals, a new downtrend. So although they can be considered as reversal patterns, after all, the price action within the flag reverses when the breakout occurs. So flags are usually classed as continuation signals because they could go either or, but think of it as three parts: a strong directional move followed by a slow counter trend, the flag, and a breakout. So of course, when we talk about wedge patterns is very similar to the flag, except that the lines tighten towards each other instead of running parallel. As you can see, they start pretty much forming into a triangle. And you can see it's wedging until it doesn't know if it's going to go in a bullish momentum or the bearish momentum. So that's something like with the wedge pattern, could either be rising or falling. After rising wedge pattern, the market should break out downward, passing the support level. And this presents opportunities for new bearish position, or it might be a signal to close a long one. So for a falling wedge, the price should break through a resistance level to start an uptrend. You can open a long position at this point or close a short one. So most traders, many traders that I've had many opportunities to learn from, they choose to enter short-term trades within the wedge patterns, but by taking smaller profits from the oscillations between support and resistance. So let's talk about, on your list is going to be the double top and double bottom patterns. So the double top is a bearish reversal pattern with two peaks at similar price levels, signaling a potential trend reversal to the downside. Conversely, the double bottom is a bullish reversal pattern with two throughs at similar levels, indicating a potential upward reversal. So as you can see, this is pretty much a double top. We go up, we try to test the resistance, we test the support line, the resistance once again, and it didn't pass the resistance and it broke out, trading the breakout, and it went down. And when you see for a double bottom, so A double bottom is pretty much the opposite. Again, it's pretty much the double bottom is perhaps unsurprisingly the opposite of a double top. It's formatted when a market's price has made two attempts to break through a support level and failed. So it's very important. In between, there has been a temporary price rise to a level of resistance. It creates a W shape. As you can see, creates an M shape, and then a double bottom creates a W shape. And usually those is always worth confirming the resistance level. As you can see, it tries to retest the resistance. And when the buy-in pressure goes in, there's more investors are intrigued into this asset class. If it's stocks, cryptos, they start to break the resistance line and they start forming a bullish momentum. So many traders do this by looking at the past price action or using technical indicators. To bring up with head and shoulders, so every trader should be familiar with head and shoulders. So the head and shoulder patterns consist of three peaks. A higher peak, which is the head, as you can see right here, and the two lower peaks, the shoulders. It typically signals a trend reversal with the price moving from an uptrend to a downtrend or vice versa. So for example, if you look at this chart, we can identify a head and shoulders pattern forming, as you can see right here. And it typically, the neckline serves as a critical level. A break below it can confirm the reversal and present a trading opportunity. So as you can see, it tested once, went down, tested the resistance line, hit the higher highs, back down to lower highs, higher highs, and then we tried the resistance, and then the breakout went underneath the resistance. So as you can see, the head and shoulders is a bearish reversal pattern, like the double top. The market hits a resistance level that it can't move past, but here the situation plays out a little differently, hitting a smaller high first, and then with buy-in momentum clearly falling as the final high doesn't match the second. So when we look at pretty much the recent charts identify the head and shoulders, you can see exactly it's a bearish momentum. So there's many trading chart patterns to sum up. As you can see, we were talking about the ascending staircase and descending staircase. In any conditions, it pretty much signals nothing. When it comes to ascending triangle, descending triangle, symmetrical triangle, uptrends or downtrends, it's pretty much bullish or bearish continuations. If you consider the bullish flag, it's pretty much bullish continuations for uptrends. Bearish flag is downtrends. And if you consider all of these, it's very important to understand which chart patterns to utilize into your trading portfolio. If you're looking for indicators to see which chart will benefit for your higher profits or your more of, you can say, stop loss orders, depends on what you really want to invest. Just be careful what you do invest, because of course in investment, it's very difficult to determine what buying pressure is going to be available, how much volume is going to be within the given trade, how many interests of the new investors are there. So it's very important to understand pretty much these examples of chart patterns that every trader should know. So as we wrap up, learning to recognize that interpret these patterns can significantly enhance your ability to make informed trading decisions. So in future videos, we'll explore more patterns and how to integrate them into your trading strategies. So if you found this video helpful, please like, subscribe, and share your thoughts in the comments below. Happy trading. I'll see you in the next video. Thank you so much.